Hi, and welcome back to Investment Banking University's Investment Banking course. We're on the first side of the perpetuity, the build side, and we're talking about valuation. We've already gone through the valuation methodologies, and now we are to framing valuation. Framing valuation ultimately refers to the combining of the different valuation methodologies into an easy to understand format, where we can discuss a more certain valuation point or range. So we are ultimately not looking at each valuation methodology in isolation, but we are ultimately using valuation methodologies together to frame the valuation in a valuation summary format. We use a valuation football field, i.e. valuation summary, to frame the valuation, which looks like the following. Ultimately, we're going to see from top to bottom the different valuation methodologies, as well as an implied range for all of them. And then we can discuss the valuation is from X to Y until we get more information to then discuss it further. Regarding the football field, we add in control premiums to comp companies and DCF, which is the percentage addition that is equal to the control premium average for the transaction comps. And that's if we're doing a valuation for selling the company. We have to footnote everything in terms of our assumptions in the football field. And the football field takes about 1 day to a few days, depending on how easy it is to get the present transactions data. So the football field is ultimately what we're getting when we're going through the different valuation methodologies and what we're working towards to then present a valuation in a more definite valuation range. So the banker should know what the valuation of the client expects to be from about 10 to 15% spread of the range in the valuation. We're ultimately going to tighten the range if needed by eliminating comps that skew the range. So for each valuation methodology, we're going to do a sensitivity analysis to determine a valuation range. And so this is kind of what a valuation or a sensitivity analysis looks like just from a mocked-up perspective. We're going to get into what it actually looks like in Excel later on in the course. So now we're going to talk about the market for perpetuities. The market for perpetuity at its initial stages is inefficient, but as it moves through the different stages, the 5 stages of perpetuity, the market becomes more efficient. And you can observe this, the coinciding cost of capital moved from almost 100% in syndication, going all the way down to about 3 to 6% in that range, depending on the company. So you can observe the EBITDA multiple as well, with the perpetuity increasing as the perpetuity moves through the phases of the perpetuity, as well as the lowering of the risk associated with the 3 key de-risking factors that we had already talked about on the build side. So as we've seen before, this is the chart for perpetuity phases along with the multiples and the key de-risking variables. We see the EBITDA multiple next to the 3 key de-risking variables along the left-hand side. And then on the bottom, we have the stages of the perpetuity moving from syndication to job shop to perpetuity to growing perpetuity to then diversified. And below the names of the stages of the perpetuity, we have the formula for the stage of the perpetuity, starting with PMT or payment, job shop being payment 1, 2, etc., and then converting from disparate payments into a benefit stream, which is where we get to perpetuity. And then ultimately the growing perpetuity, adding in the growth rate, decreasing the denominator to increase the valuation, and then going to diversified, where we have perpetuity 1 plus perpetuity 2. What we see in terms of likely buyers is from syndication to job shop, we have individual buyers being the likely buyers, along with lower middle market private equity and lower middle market strategics. As we move into actual perpetuities and growing perpetuities, we get to a more efficient market in terms of valuation, and as well as the middle market private equity and middle market strategics, in addition to some public strategic and financial buyers participating there. And as we move to diversified, that's where we start to get into definite public strategic and public private equity, and possibly even an IPO. So now we're going to go straight into the second side of the perpetuity, which is known as the sell side. And this is where we're getting into the actual work of the investment banker. So of course the sell side is associated with the selling of perpetuities. Investment bankers in Wall Street is typically what this is thought of. So as perpetuities continue to grow, the builder of the perpetuity seeks to grow the perpetuity inorganically or exit the perpetuity. This is the primary role in the sell side, which is to aid in the buying and selling of perpetuities. And the investment bankers now enter the picture. So the key question associated with the sell side is how to sell perpetuity. On the sell side, the primary responsibility of the investment banker is to aid those owning perpetuities in analyzing their own strategic alternatives relating to growth or an exit. So we're going to be asking, what phase is the perpetuity in? Is it in its initial phases? Is it job shop? Is it a perpetuity, a growing perpetuity, or is it diversified? In which buyers are likely interested in the perpetuity given its phase? Each of these buyers have a different valuation range. In terms of the individual typically has a 30 to 40% IRR expectation, which when we're talking in terms of a multiple is typically going to be in that 3 to 4 times range. Financial buyers are looking at an IRR in the 25% range, 20 to 25% range, which gives you an implied multiple of 4x to 7x EBITDA, or 4 times to 7 times EBITDA. In terms of a strategic buyer, since they have synergies that can be realized with the target company, we're looking at multiples that are going to be in the range of 5 times to about 10 times and greater. So valuation, of course, is a range, and we've already seen that with the football field concept. So we're ultimately going to be determining a valuation method and then calculating the benefit stream. We're going to have to determine the required rate of return given the phase of the perpetuity and the buyer. So are we dealing with something that's a perpetuity that's going to be for an individual buyer, a financial buyer, a strategic buyer, and at what phase? So we're going to have to convert that benefit stream into a present value at the discount rate and then sensitize the variables for a range of values to see the effect on valuation. This is going to be done in a sensitivity table. So strategic and financial buyers establish their filter criteria, i.e. hurdle rates for financial and minimum EPS increase for strategics, and then test targets against this filter. Does it meet its hurdle rate? Does it not? So strategics have a range of values with a standalone value as the lower end and valuation with all synergies on the high end. And a deal usually happens somewhere in the middle. So now we're going to get right into investment banking. Since M&A, mergers and acquisitions, is the core product of investment banking, discussions around investment banking typically relate to M&A. M&A is the selling of a perpetuity in the form of a corporation to either a financial or a strategic buyer, and sometimes an individual buyer. Financial and strategic buyers have what is known as investment corporate M&A mandates, which detail the size and industry of prospective targets for acquisition. The investment banker takes these mandates and matches them with targets and takes a fee for doing so. The investment bankers typically focus on one industry or a few industries and provide what is known as coverage by building an index of public companies and tracking changes in targets relative to the index in terms of revenue, EBITDA, and multiples. We're going to get into that in a little bit. The investment banker ultimately monitors trends in these variables and determines the optimal time to sell when multiples are strong or when to acquire when multiples are weak, and advises the target management accordingly. When a target agrees to sell via an investment banker, this relationship is known as a sell-side mandate, and an M&A process will then be led by the investment banker. During the M&A process, there are definite steps and deliverables, including a teaser, SIM, management presentation, as well as LOI and purchase agreement, but those are typically done with the help of a lawyer. The M&A process can include many prospective buyers if it's a broad auction, or a few buyers if it's a targeted or negotiated sale. The investment banking core product is, of course, M&A, as we just mentioned, and as such, the investment banker's role is to aid in the growth of perpetuities via inorganic growth by a merger or an acquisition. And the real work in M&A for the investment banker is, in fact, origination, matching, and mandate target matching and deal structuring. Financial modeling and valuation is merely for decision support, and deals often get done simply based upon precedent transactions analysis, i.e. a market multiple. Thus, the priority of investment bankers is to obtain a base level understanding of financial and modeling and valuation, but then immediately to start doing origination in originating sell side and buy side mandates. And we're going to talk about how to do that with a proprietary methodology of Investment Banking University later on in the course. So investment bankers explore strategic alternatives, i.e. value creation opportunities, with the corporation's CEOs or owners. And in terms of the ultimate aggregation of the different valuation methodologies in the football field, the midpoint of the football field when combining the different valuation methodologies is the final valuation of the company. And of course, we're going to be talking in terms of a range. So we're going to be calculating the NPV and IRR to the sponsor in an LBO, or EPS change and the balance sheet effects in a merger. And we're going to compare NPV and IRR, or compare EPS change and balance sheet effects to other strategic alternatives and choose the highest return or EPS alternative. So the investment banker is ultimately going to use the valuation methodologies to determine the valuation ranges of a strategic alternative and see if the capital sources match uses. Investment bankers should provide a client with tight ranges on valuation. And ultimately, we're going to be using and building an operating model of a target and an acquirer if strategic, and then tailor it to a specific client depending on whether the client is a financial or a strategic buyer. If it's a financial buyer, we're going to be talking in terms of an LBO. If it's a strategic buyer, we're going to be talking in terms of a merger model. And just overview of how a traditional investment bank is structured. There's going to be the junior bankers, the mid bankers, and senior bankers. So in terms of a junior banker, you're going to be assigned industry coverage. You're going to be doing comp and comp transactions. What are the multiples? And then ultimately aiding in calculating valuation. A mid-level banker is going to be helping with operating model creation and tailoring this to the transaction's client, either an LBO or a merger. And then ultimately, the mid-level banker is going to help manage the M&A process. The senior banker is the revenue center. The senior banker provides origination and mandate target matching, as well as deal structuring, and the senior banker's personal contacts at firms ultimately win engagements. So that's it for this video. We're going to talk about the how to become an investment banker methodology with Investment Banking University in the next video.